Hello to all our friends from the Financial Advisor Group. We just wanted to pass along a mid-August update with, at the end, you'll see some of our thoughts on this market and what's the right expectation to have, as we talked about last time, and give some thoughts on some of the headlines of the day that we keep seeing economically in front of us at this point in time. So we can jump right in today. As we talked towards the end of the slide, we'll talk a little bit about market-wise, how pullbacks are normal at this point in time, that markets tend to get a little bit volatile. But before we get there, let's talk a little bit about some of the headlines we see today. When you turn on the TV today or read anything today about economics, the first thing you tend to see, right, is something negative, right? Let's take this massive amount of credit card debt that we've now built up as a country. One thing we've said to clients over and over again is, what do Americans like to do? Spend money. And we're good at it, right? We're all guilty. And credit card debt is basically at the highest level it's ever been. That sounds scary. But taking one piece of information doesn't really paint a big picture of everything else. So we'll dive into that a little bit deeper here as well. And yes, it's scary to see headlines that continue to pile up credit card debt, which now I believe we're over $1 trillion, an all-time high. And you think, oh my God, this means we're about to fall off a cliff. People can't pay this back. But what if we put this into context? This actually looks back to credit card and consumer loans, all revolving credit, going back about 10 years now. And if you look at the chart on the right, what you'll notice is prior to COVID, we've been on this upswing forever. Newsflash, we like to borrow money. We like to spend money. COVID put a freeze on it. It was sort of a fluke because you couldn't do a lot of things, so you couldn't spend as much. So you started paying down debt, and you saw credit card debt actually fell during COVID. What we're doing now is just catching right back up to the trend line as though COVID never happened. So we're back to where we would have normally been if COVID never happened. So this isn't a huge scare. We're just back to trend line. So when we look at this chart, it's not that bad. It's where we should be at this point in time. If you dive in a little bit deeper, this chart has a couple things going on, but let's focus on the blue line. This says that 9.7% of our disposable income that's coming in on average is going towards debt payments. That's actually close to the historic lows, right? This chart goes back 25 years. Prior to 2008, 2009, this number was much higher at 13, 14%. So today, sitting at about 9.7%, we're back to where we were pre-COVID. So it's not scary yet, right? Can it get scary? Sure. The point we'd make is it's not scary yet. If we look even further into this, this shows the total debt that people have to their disposable income, similar to where we were. The chart we just looked at before, again, we're back to basically the same place we were in 2011. That total debt is relatively unchanged since 2011. Again, partly because COVID had us pay off debts, not because we wanted to, but because we couldn't spend as much and had some built up cash. Let's take this a little bit further. And what we can see today is the percentage of consumers with collections on past due loans continues to be on a downward trend. Sure, we're probably going to see this pick up a little bit, but the proportion of consumers in having things in collection over the last 20 years is trending in the right direction. Are we going to see delinquencies pick up? Sure, right? That's what happens as you build later into an economic cycle. But all this stuff, the point we want to make is this is normal, right? The headline number of $1 trillion can be deceiving when if you look underneath the hood, these are all things that are in pretty decent shape at this point right now. The last point we'll make is don't doubt the consumer, right? The consumer in this country is a very strong spender. And what we spoke about last time is that this consumer today, most of them have jobs, most of them are making more than they ever have, and most of them have no fear of losing those jobs. You combine that together, we like to spend money. On to the markets, right? So we talked about this about 10 months ago. We started talking about the healing process and how the market was a wounded animal and needed to heal. Well, you've seen that healing process play out. If you look back from September and through today, the healing process played out. So we've come a long way. The market at one point is up about, I think, close to 30% off of its lows back in September. So what happens typically after that? It's a good question, right? I think in our minds, we want it just to keep going up. Historically, though, that's not realistic. That's not the right expectation to have. When you come this far, you tend to have pullbacks. In fact, what history actually says is in almost half of the years when the market is up by 20% or more for the whole year, there's been a double-digit fall in the market at some point during the year. So even though at the end of the year, the market may end up 20%, at some point during the year, the market has a fall of over 10% historically. So what this chart looks, let's pick a year out. If we just pick out a year like 2019, the market was up 31% in 2019, but during the year at one point, the market fell 7%. You've had years where the market was actually up 40%, yet during the year, you had the market fall at some point 16%. So it's normal, right? Let's talk about setting the right expectation. It's normal that when a market has a run like this has, we should expect some type of volatility or pullback at this point. One of the best ways, Carl Richards, who's one of the best people at illustrating some complex thoughts in simple charts, shows right here. It's all about expectations. This is not normal. This is what we want, right? If we draw this line, we want that straight up line. But if we have the right expectation and understand that what's actually normal is a market that's more volatile, but over time heading in the right direction. So our stress today is we've come a long way from September, which is what we thought would happen. It happened pretty quickly in 10 months. So we're probably due for some of this volatility as history has taught us. So it's okay to expect that this market may hit a speed bump as we've headed into August and head into the last part of the year. Long term doesn't change our thought on anything. Companies are in great shape. Sure, that R word, recession word, will get thrown around a little bit more now and then. Again, recessions are to be expected. They happen. But big picture, we need to have the right expectation that we've come a long way. Long term, we're still big fans of the market. To jump on to something a little bit more exciting, we wanted to pass on two big congratulations to two people very close to us here at the office. One, congratulations to Jake. Jake has been with us now for about 2.5 years, actually closing in on 3 years. And one of the things he's been working on while becoming a new father and being a good husband is also working on getting his CFP. He's been juggling a lot the last 2 or 3 years. A huge congratulations to Jake, who recently passed his certified financial planner test and now has officially been able to use the marks of the certified financial planner practitioner. Huge accomplishment. It goes back to our company if we really want to be the most educated advisors we can be for you. So he joins us here at the office as another CFP we have on board. Congratulations, Jake. And you might recognize the lady in the picture on the other side. Congratulations to Diana and her son Brandon and wife Chelsea, who had a baby boy in July. His name is Carson. And Diana's enjoying retirement just a little bit, getting to travel, getting to spend time with her husband, Dan, who recently retired, and now getting to hold her grandbaby. I'm not sure you could script retirement any better. So big congratulations to Jake and Diana. These are the type of accomplishments that we want to, focus on. The world's crazy. It's going to grab every headline it can. Yes, debt is at $1 trillion, but focus on life. Focus on what we have. That's the important thing. My favorite headlines every summer is "It's hot out." That shouldn't be news to all of us. Every summer it's hot. But again, it's something that what can pull us in and get our attention. So let's focus on the right things. The last comment I'll have, last week dropped off before talked about Keenan and the great summer he had. I'll say go Tulsa Golden Hurricanes. Last week we dropped my oldest son Liam off at college. He's a freshman now at the University of Tulsa in Oklahoma. So I've recently become the biggest University of Tulsa Golden Hurricane fan there is. So go Tulsa. Thank you to everyone for the trust and confidence you continue to place in us. We'll be placing out some more videos in September and October. They'll probably focus a little bit more on a topic like Medicare as we get into Medicare season, just with some informational topics as opposed to boring you with our thoughts on the markets. Thank you as always. We appreciate all the trust you place in us. We hope you continue to have a great summer and focus on the good things. We all have so much good and great going in our lives. Let's not get distracted by chasing perfect. Make it a great day.